What?
Hello, warriors. Get your pens and pencils out and paper and record this as well because you're going to be getting great input from an elite technician. Peter, welcome to TradeGATEHub. Appreciate you joining me on this channel. I know I've interviewed you on others, and I'd like to start off with that you're a musician. So I'm interested in how that related to you ending up being a trader and just having that type of knowledge of music. Everything is, there are harmonics in the market. Why don't you tell us how you ended up becoming a trader?
Well, I was in college very early, so got to college when I was like about 16. And that was a little too early for me to start, actually. It's a little social pressure there. But I ended up going through things pretty advanced and ended up going to Manhattan School of Music and Juilliard for piano and composition. And the funny thing is that I felt like I wasn't learning what I needed to learn. It was very interesting that in Juilliard, which is why I went to Manhattan School of Music, in Juilliard, I asked them, I said, well, where's the jazz department? Because I'm a composer, I want to learn jazz. And the guy actually said, jazz is not serious music. So I practically had a heart attack. It was like, how could you be a composer and not, study jazz? And so then I ended up going to Manhattan School of Music because they had a great jazz department. But the interesting thing that happened there was that I learned you can't follow the whole idiom of what happens in school. And I started just breaking out and experimenting with everything. And at Manhattan School of Music, they didn't have a recording department. They had like this little horrible recording studio. So I just started diving into technology and into recording, working with, I said, okay, well, since they don't do this, I'm going to go start doing modern production and working in recording studio with, TV commercials and film scoring and stuff like that. And that got me into computing. And so once you get into this kind of mode with computers, you start connecting all sorts of dots that don't normally connect. And I started writing software. So I taught myself all this stuff. And then I ended up getting involved with a whole bunch of database programming and plugins for Photoshop and other kinds of things like that. And how I ended up involved in trading is that a lot of the algorithms I was using to manipulate pictures, I was looking for answers for. And an interesting thing about working with pictures and sounds, because I ended up working in film and I ended up working, with the not only the sound part of film, but also the visual part. When you're writing plugins to manipulate live content, to manipulate something that's recorded, you have an awful lot of noise. And then you have your signal. You have all the harmonics, you have all of the noisy stuff. And then you have the stuff you're trying to control. This is very similar to what happens in the stock market. You have a very noisy situation. And then you have what you think is your signal, and trying to identify how to interact with that is very difficult. So I had developed a bunch of programs, and this is something, when you're manipulating a sound, for example, if you try to do it very perfectly, you lose all the harmonics. You mess up all the noises that are in the sound that make it unique. So you have to actually think about everything in a very cohesive way. You have to appreciate the noise and the error that nature produces, and then you can work with it and move it around and do amazing things with it. What was interesting is that these algorithms that I was working on, JP Morgan was interested in. And I had
Okay.
actually been connecting with
How'd they
them.
find out? How'd they find out that you had these algos
Well,
as a
because
musician? I'm
Well,
curious.
because I'm doing research on them, and at the time there wasn't a lot of places you could do research. At the time, I think it was in AOL chat rooms um, about certain types of technology, and JP Morgan didn't have many better options either. So they were in
Looking.
there too, and so I struck up conversations with people, asking them questions for things I was struggling with. And what happened is JP Morgan realized that I knew more about the subject than them. They called me in and asked me to interview with the risk metrics team, derivatives group, and I got a job there with never having worked in finance, no math degree, whatever. They offered me an insane amount of money, and I came over there and I worked there as a consultant for about 15 years.
Wow, and that's how
And
So
that's how. So then
what
I
a
ended up.
story! What a great
So
story!
I ended up writing programs to. I left actually when I realized that what we were doing with all of these sort of spline based uh, uh, computations, these derivative computations that we were doing, quadratics and all sorts of other kinds of things that we were then trying to integrate into a very noisy market environment. We were doing CDS, credit default swaps, and other kinds of repo. I worked on every desk through my time there in derivatives. So every area there was exotic derivatives to credit default swaps, et cetera. And basically, when I started to realize we were doing some stuff I didn't feel comfortable with, I left because it was in 2006 during the housing crisis. The CDS book started to look really, really bad, and every month we were like changing the way we calculated the values of things so that the books looked better.
Yeah.
And I felt like I wasn't doing something illegal, and so I left. I was like, I'm not going to do this anymore. And then I ended up working with the U.S. Bank and Piper Jaffray on independent.
Yeah, you
projects.
did the tour. You did the
Yep.
tour, and then you said, then the internet became even more accessible to many more people, and your entrepreneurial spirit said, "Why am I working for anybody but myself?"
Well, it was a really incredible experience to learn about how these huge work, and also some of the bad things that happen there.
Yeah.
But I wanted to take that experience and use it in for the better, because a lot of decision making there was really poor. In terms of trading. So if you're trading for a client and you get a markup, that's one thing. If you can, but if you're trading for risk and you screw it all up, which they did a lot.
Like every regional bank did, being long duration into the biggest hiking regime in history.
Exactly.
Yeah, don't they have risk managers? And why didn't Powell tip them off, since they went in on his call to support, QE? Why didn't he tell them they had duration risks they should do something about?
No, this is actually a really, really important point you're making, because when you know that you're going to be raising interest rates by a lot, and you're the regulator, it's your job to be in communication with every bank that you regulate. Right. And it's your job to also inform them of what kind of risks they might have, and maybe even give them a product to manage that risk. I was talking about this with somebody not long ago. Basically, all of the crisis they created by raising rates the way they did, and then
it was intentional. It almost felt intentional.
The thing is they could have created a product for these banks, so they could have easily just gone to some sort of a window at the Fed and traded in loss risk for no risk, and then they would have been fine. The problem was that the Fed can absorb as much loss as they want, and the banks couldn't. Right. And they could easily have given them a product to mitigate most of that risk, especially if it got out of control. But the biggest problem is, the banks it's very, very expensive to hedge, and most people don't hedge. JP Morgan, in most situations, like to do as much.
We lost you for a minute. Are you back with us, Peter? Yeah, you back with us? I can't
Can you
hear
hear me?
you. I can hear
I'm
you
with
now. Okay. So we
Okay,
had
you
a
can hear.
little glitch. But
Yes. So hedging is very expensive, and basically, all these regional banks and all the banks are
not hedging is more expensive.
Well, it's more expensive if you
needed the
if
hedge.
things go wrong. Yeah, if you need the hedge. But
I mean, I don't buy fire insurance because I'm planning a fire.
No, I understand that. But the problem is that if you're one of these banks and you hedge these portfolios, you end up losing money. There's no way you're going to make money over years. They don't have the right product to do it. They needed the Fed to give them a product that was financially feasible to hedge with. And the Fed deliberately avoided that and deliberately avoided discussing with them, the rate risks that they were going to be facing. So everybody was thinking, we can't just wait this out anymore. I think that the Fed deliberately created this problem. I think they deliberately exacerbated the problem. And they're still doing it. If the Fed had come in and just offered all these banks when they knew things were going to get stressed, they knew their balance sheet problem, they just offer them some sort of a solution, it would have cost a couple $100 billion, which is far less than what we're going to end up paying.
Yeah, and it would have, not over.
No, it's definitely not over. And that's part of the stuff we're going to discuss in my charts here, because it's all right.
So let's get to them. And before we do, I've seen Peter call turns before, and I just want to let our viewers know that unlike a lot of bears, myself included, who got bearish early, Peter was long during this rally that we've had over the past several months that had targets that were attained. And it wasn't until the last week or so that he started scaling into short positions in the S&Ps. So he's not the kind of guy that's always saying there's going to be a decline, there's going to be a bear market. He can hear different music. And it was a different song for a while, and now the song may be changing. So why don't you just tell us? Go ahead.
I'm going to tell you, I was early too in 2021. I was short.
I'm just talking this year. I've been early every year. I'm only talking recently early.
But that was an interesting scenario, because it actually started the process of what's going on right now. If you remember, in 2021, the dollar was very strong, and normally the dollar being strong for, like, say, 4 months in a row, I allow the market to go up then, and then at some other point I say, okay, wait, this is now reaching the point where the market is going to soften and turn. But in 2021, because of Bitcoin and a bunch of other things, the dollar kept being really strong. And what I'm saying there is people were selling Bitcoin and buying dollars and trying to put money. They weren't even selling Bitcoin. They were borrowing money from Bitcoin and trying to buy dollars and then put it in the stock market. And that pushed the stock market really, really crazy up because of that dislocation. I think more than pretty much anything else. We have all these artificial knock-on effects from the Fed creating liquidity, and the Bitcoin scenario was one of the last ones, because everybody knew that it was going to collapse, who was involved, and they wanted to get into other assets thinking they could weather the storm. Now we're in a much worse situation than we were then. It's a very interesting situation because it's much, much worse. But that's part of what I wanted to talk about with you guys today, because we're looking at a chart here that is discussing something there's two patterns that happen that are related very much to liquidation or credit excess or destruction of liquidity. And one is called a running correction, and another is called an expanded flat. And what I have found in my life is that if you don't know how to see those patterns early, or at least have an idea they're going to happen, you go bankrupt. And I wanted to talk about this today in the form of teaching people, one, where we are a little bit, and then how to identify these patterns. Now this chart is my final chart on this this pattern for a while. So it's like I put all my notes on it, where, you know, basically where I took shorts, where I believe the situation is, where I think the situation is going. And it's very important to understand that when you have a credit problem, a liquidity problem in the markets, which we did in 1987, we had the same situation where we thought somebody was going to be able to take care of everything and there would be no problems and everything would be wonderful. And, you know, we have portfolio insurance. We didn't have to worry about anything. Nobody can ever lose money again, was 1987's rule. And of course, when you run into a liquidity issue, then your insurance doesn't pay when everybody has the same problem at the same time. We're dealing with the very same situation right now, except on a much larger scale, and one that is going to affect the economy very deeply. So the dotted red line here is 1987. Okay, but it's not 1987 in the way you're used to thinking of it. It's 1987, if you look at it, look right here, at 5.7 2023 days for every one 1987 day. So the crash in 1987 lasted, I think, about 23 days or something like that. So we're going to have something like around about, 120 trading days here of downside in the market directly before we have a big bounce.
So that's 6 months.
Something like that. Okay. And if you look, I haven't really changed this chart. No, that line has been following this exactly. Now, why did I know that was going to happen? Because it was an expanded flat. And how do you know that we had an expanded flat? Do you see this right here? We have, I can't, let me see, maybe I can. Yeah, I can do this.
I see the B way A and B, and this long recovery is C.
Yeah, and so
an expanded flat is a Elliott term.
It's not really. I wouldn't really say that I consider it. It's a structure. I wouldn't consider it Elliott wave really. It's just a technical pattern. But you see, what happened here is we had 3 waves down into this low. Now I'm going to teach you guys all something that I think is very important. A lesson took me a long time to learn. Don't use candle charts only when you're trying to identify patterns. The wicks on candles make you buy into arguments that are not accurate. You should really check your charts whenever you're looking at something for
use line charts.
The closing prices. The closing prices are the most important prices,
right.
And they're the ones that all the professionals are looking at when they're making decisions. So right here, we had one segment, subdivision. I'm not talking Elliott wave. I'm not an Elliottician. I do not like using Elliott wave, and I'm not good at it. But I'm very good at identifying bearish and bullish running corrections and bearish and bullish running flats, because if you don't do that, you go bankrupt. So here's wave A for the zigzag. We have wave B for the zigzag and wave C. And that was a new low. So what does that mean? As long as we don't, so as long as that is happening, that means that we have an irregular. What normally should happen is we should normally have this. I'm going to just draw it out. Okay. So we should normally basically have, actually, I'm just going to do it the way people would like to have seen this. So normally, if this was going to be bullish kind of thing, you would wanted to see an ABC zigzag like this, where you make a higher low, and then then you can go get your last C wave up. So then you can go now to, so this would make this a bearish move where I would have expected this. Okay. But because we didn't have that, because excuse me.
Because we
Come on, go
made
away.
that B low change the whole picture.
Because we made that below what you know, and I want to explain the psychology of this. It's very important to understand the psychology and
Got
what is
everyone
happening behind it.
bearish. Yeah.
Is that everybody thinks that this is now going to be a fifth, an impulse down. They get very, very negative. And the people who got trapped in here think that we were going to have this ABC like I just drew. So they think we're going to go up one more time, and then we go down. They stop out and reverse short. And now you have all these people to squeeze. And then the other thing is that when we bounce, they always think every bounce is going to go lower. They always think we didn't finish the low. But the problem is if you make a low with 3 waves, you're not going to take that low out almost ever. You're going to do the expanded flat. Yeah. So let me show you what I did in.
What can I ask you, Peter? What do you mean by gold is the 2023 SPX?
What do you mean?
You have it written. Gold is a 2023 SPX, right on the chart in the middle.
Oh yes.
Oh,
that is.
I see. I'm thinking gold. All right, go ahead.
Okay, so the gold line is the 2023 line, and the red dotted line is the 1987 line.
I see.
So, this is a basic definition of what happens when the expanded flat. This is pretty good, okay? So that people should screenshot that. I'm going to show you why this was so visible. See, this was from October of 22, and you can see we were just off the low, and it became very clear that we were just going to put in 3 waves to a low. And when that happened, you see this line, the red line in the background was my 1987 line. I knew that this was a high risk situation of happening. And so then this was the projection. We had 2 situations. Whenever you get 3 waves to a low, you can either get a running correction, which I've identified here. This is a black line, where you bounce up and you make a lower high. And then once you start this bounce,
trying it up there. Yeah,
once you get to that line, people think we're going to, now it's so bullish, we're going to see, higher, and a running correction would trap everybody. And I'll explain why. So there's 2 liquidity patterns. You get people to short down here at B. You get them all bearish. They're bearish all the way up. And then when they get to the top of the running correction, they're expecting, that they've got to reverse and they've got to get long, or they're busy stopping out. And that's why the running correction is really dangerous, because again, people are expecting a simple pattern, and when they start to enter off of A, they're expecting a simple pattern, a small higher low for a little pullback, and then they're going to expect to get C. So, but instead of the B being up higher, it's lower, and it messes everybody up, and they have to leverage themselves into their trades. They are forced to add, or they're forced to do things they don't want, and usually those things don't work.
So let me ask you this, Peter.
So, but the most likely situation when you make a major low, like we did in 2022, that's only 3 waves, is that you're going to do that and make an expanded flat. And this is why I thought we would do an expanded flat. We can't see the numbers here, but this was looking for basically 4410 was the target on the SPX. So 4410 to 4450.
What will confirm this scenario? Will there be price action underneath that'll confirm that this scenario is underway?
I think
we've come off a little bit, but would it take like 4,200 closing back under 4,200 or something like that?
That pretty much would, closing under 4277 confirms, 4280 confirms it. Okay. So once we close under this red line right here, which is around 4280, then we are completely done. Now I'm gonna, so this then was my last chart. So this is the last chart from the 16th with no notes on it. This was from the 14th, and this was from October of 2022. And I'm just showing that because it's so important to understand what expanded flats do. And what happens in expanded flats is very interesting. People they're bearish all the way up. And then finally, the last 150 points, they go hyper bullish.
NVIDIA,
Yeah.
AI.
And this is characteristic. It happens every time. It is, if it's a small expanded flat, like something that's an intraday thing or maybe on an hourly chart, it still happens that way. People get the most optimistic that they can be for that cycle right at the top. And you can see here, this is a search for the terms bull market in Google Trends. And you can see that this is the highest ever number of people looking for bull market in history. And when did it happen? Yeah, it happened right at the top of an expanded flat right here. Now, where did those people go bullish? They went bullish right in this area that I'm showing you now, the last right there. They literally, all these people flipped bullish right there.
Yeah.
And that is exactly what happens with expanded flats. And so let's take a look at what the implications are. Firstly, I think the 1987 crash is a good analog for this, but don't expect it to happen in one day. It's going to happen, basically, the more computers we get involved in everything, the more we have all this crap going on in the world that we do, the slower people are at making decisions. Unlike and even in 1987, people were slower in general in making decisions than they were in the 1920s and 30s. Things happened faster because people had to be faster in a strange way. More data you have, the more reasons you have to come up with excuses for why you know what's going on, and you can make a decision one way or another, and you're usually wrong. The thing is, you're better off being wrong fast, and computers tend to make you wrong slowly. That was one of the other things I learned about, from dealing with nature and mathematics, modifying sounds and images with code. A lot of things you think are going to work actually make things much worse. So technology is your friend when you only use it sparingly. When you use it too much, like what we're doing right now, people they don't help themselves. And so that's why what we're dealing with is something where it's going to take about 6 months to get the same kind of crash that we had in 1987, although I think this is going to be a little worse. I think we're going to be down more than 30%, probably 40, could be 50. And it's probably going to look something like this. Okay, so I think we have a decision point here. I think most people, now this is what I see right now. We had a throw over and we are now under that throw over. A throw over is terminal, in my opinion. So that means we're not going to get another high. We're not going to come back up and test this upper rail. Okay. The best scenario, I think, is we come down here to about 41.10, 41.20, then do a bounce. And if that's a shallow bounce, then we're going to crash through 41.50 once that bounce is done and break down. And then I think the target is going to be about 3,200, 3,250 for this initial move. Versus the derivatives markets right now, this is a program I wrote to look at them. We had the highest dislocation in terms of a combination of things that I look at in derivatives markets versus what people were doing in cash markets. And you can see that it works pretty well to identify where highs are. Now, this is an interesting chart, and this fits very well with an expanded flat. So we have our expanded flat, and this is a mania chart, which I put together, and I decided that it would be a good idea to look at the real S&P 500 in terms of the mania cycle that people go through. So, up here we were at a new paradigm. Everything's there's never gonna be another financial crisis. Then
Right.
here we get used to there's going to be a financial crisis, and over here now people are saying everything's okay,
You
and
know
now
what's
we're
stuck in my head,
beginning.
Peter? That, I think a lot of things that happen in media, life imitating art.
Yeah,
But after the deal was done on the debt ceiling
yeah,
and President Biden was giving his address, first one from the Oval, and
mhm,
underneath it, it said, crisis averted. And it
yeah,
reminded me of Bush's mission accomplished. And then the
yeah,
war really began. So, I
yeah,
mean,
and
that hubris that the crisis was averted when there's all these crises bubbling all over, economic, geo, everywhere.
yeah,
I thought that was kind of a tell.
yeah,
I wanted to
and
short everything after I saw
well,
it that day.
yeah. I
And it
mean, I
was
think
close to
that
the top.
yeah, and I think that actually is a good instinct, and I think that's going to be right. And I want to show you about that because um, this was my chart. I don't have the original ones from last year, but because of this expanded flat, I was able to figure out a lot of other things. One of them that rather than the people think that the dollar is going to go up when we have a debt crisis, they think when the stock market's crashing, the dollar is going to go up. That's not going to happen initially here. I think we are going to have the dollar. We have a weekly breakdown right here. You can see. So my projection, which is unchanged, including for this bounce, which is here,
Yeah.
is to come down and sort of basically test into the 95, 94 area.
Wow.
And then I sort of explained this to try to explain to people what may be happening. I had written this before the debt ceiling, like in February and March, that I thought that they would suspend the debt ceiling, which is exactly what they ended up doing, because that's the only way they can get the cover to, the Republicans look okay and they concede to the Democrats, and the Democrats go, oh, great, we have this suspended debt ceiling. So the crisis, I don't think, is really going to start until the banking crisis comes back. And this is sort of what I want to talk about. Basically, what we're going to have, I think, is that we get the debt ceiling, the dollar is going to keep dropping as we are printing more money, as the government is printing more money. But then when we get towards the bottom of this, like right around here, we're going to get crazy issuance of treasury bonds that is above the budget that is theoretical. Right now, we have a theoretical budget, and everybody agrees that budget was acceptable.
Yeah, you're looking for a bond rally, Peter, with risk off,
Yes,
right?
yes,
And a
and,
weak dollar, which is
yeah.
that's gonna catch a lot of people off sides because
Well,
they'll
just for a
go ahead.
little bit. It's not going to be
Well,
for
that's a
long. We're
big
talking
break
about
to 94 from where
yeah,
we
yeah,
are.
yeah.
That's like what, 130 euro?
I
120?
don't 120 something like that.
Yeah, okay. So it's still a big move.
Um,
Yeah.
so, but basically, what I see here is these are the notes that I put on this. I haven't changed it since we, I think, just before the debt ceiling vote. I added some detail to it, but basically, my thinking is that we're going to end up with the dollar going parabolic to new all-time highs after the Fed is forced and the government is forced to issue way more treasuries than we can support in our budget. And then this supports this scenario here where, basically I was looking for the S&P to come back up and complete the expanded flat, which meant that we needed to go above this price. See that little gray line? We needed to go above that, which we did. And then gold comes down and retests this breakout and then basically goes to 10,000 or something like that.
Wow. So you think 1920, we're there again today, is going to hold?
Well, I think ultimately the symmetry for this down move, the C wave should be longer than the A wave down. So I think we're looking at testing the 2020 lows here, or certainly below 3,000 by February next year.
And the gold, you think, is going to hold 1920? We're right there now.
Yeah, I think gold is going to hold this. This is a shakeout right now going on in gold, in my opinion.
Not much of one. I thought we might be able to see 1800 again, but not with
No,
that
it's not.
wrap.
It's not much of one. So let's take a
Okay.
look at a few other things. So
All
here's
right.
the S&P 500 with the Nasdaq um, and the Dow, and I call this an orthodox parabolic top. So I'm kind of expecting that the Dow is going to be a little stronger right now than the S&P and the Nasdaq, and that often happens.
Will the
Uh,
NASDAQ become weaker than the S&Ps? It was stronger on the
yes,
way up.
yes,
Okay.
yes, it will, in my opinion.
All right.
And so I would be looking for the Dow to see just to be a little strong here, get a little push up to a lower high. It doesn't have to be much. It doesn't have to be even where I drew it. It just has to be a little bit.
Yeah.
And then we have these expanded flats completed on the NASDAQ and on the S&P. And you see we had a potential for a running flat, which I drew in here, a running correction. Though that would have been devastating if it had happened, but it wasn't likely. So let's take a look at the larger picture. That's kind of what I think the first leg of this looks like. So I think we're on a very simple level. We should see waves down into test, 3,200 ish, and probably undershoot that. So it could be 2,900. I would say that we should undershoot it for some amount.
Okay. And that's when into mid 24 into.
I think that's I drew this with too much time, to be honest with you.
Yeah.
I have the timing in February, basically early February is where I think this low is made. This is another chart that I've been maintaining for years. Okay. It's a momentum channeling chart. So we basically came up and tested the momentum channel here. And so now we're starting a down wave, and that down wave can be very serious in my opinion.
I tell you what, you're like a good attorney, and good attorneys have a lot of evidence that they bring to build their case.
Yeah.
And I'm just seeing chart after chart of things I would not have thought about that I knew when I brought you on. I would learn some things from you. So why don't we go to your most important chart, Peter, and then show the viewers where they could follow you, get a hold of you.
Okay, absolutely.
Okay.
Well, let's just look at one other thing that people should watch for now. I think could be helpful is the S&P. I think needs to bounce a little bit here and make this right shoulder. And a lot of people are saying, no, you can see the head and shoulders, but you have to remember when you have an expanded flat, you just got everybody long at the top for the last 100 points. And then, and then you have a liquidity problem. Now, everybody's talking about Fed liquidity. I see every trader now looking at Fed liquidity and trying to figure things out. And they find anything that looks like it's going up. And if it supports the stock market going up, they say, okay, that's Fed liquidity. Like a big one is this banking index, the banking emergency funding that the Fed has done. Now, let me ask you a technical question. Let's say that you created $100 billion and you gave it to a bunch of insolvent banks. Is that going to drive the stock market? No, it's not going to drive the stock market because those banks are not going to.
The bank shares look terrible. XLF, Goldman. I mean, that's my bear case is the banks, because they're the central nervous system of the economy.
Yeah. So, but what I think is going to happen is I do. I agree with
the
that.
Brain.
and I think, you shouldn't look at head and shoulders patterns and say everybody sees them, so they're not going to happen. I don't believe that. I think this is an obvious, the head and shoulders pattern is likely to work. And we're probably going to have a double head and shoulders pattern. And when this larger one breaks right here, then we're going to see a much larger move down. So let's go find another important chart. Let's see.
They were all important.
This is kind of the bond market situation. I still think that the bonds are going to be putting in a short squeeze, sort of like this. It may not be as strong as that, but I think it's going to be there. Basically, we have a classic situation where people are more emotional, and this is something I like to watch, where people are super emotional, but at the same time, they can't get prices lower. So in the bonds are here, they can't get prices lower. And so I think that's going to spring higher. And that makes sense also
Yeah,
for a
well,
lot of other
commitment of
reasons.
traders have record short positions, so there's plenty of
Yeah,
fuel.
yeah. Now, one of the reasons economically is this, because I put this chart together and it's a very interesting chart. This is the cardboard shipments versus the sort of implied future inflation. And so this is the Cleveland Fed, the blue line that is the Cleveland Fed expected inflation. So they know that inflation is coming down. But how do we know where it's going? We can look at shipments as well. And the next chart is very interesting because this shows also the New Zealand birth rates, and which is, birth rates are declining all over the world. And they're very economic. They drive economics.
Yes,
so the
demographics,
economy is going to be affected by this. This is what I think is going to happen to these lines. I don't think that we are going to get bounces in these things. We're going to get a stagflationary deep depression or recession. And I'm thinking that it's, I don't know whether you want to call negative 6% inflation and depression. I think you probably would, but I think we're going to go there. I think
negative 6% GDP or inflation.
Negative. I think we're going to end up with around negative 6%, negative
GDP.
7% GDP.
Okay.
And then when you look at this here, we also have, the commodity super cycle underneath.
I love
this,
the grains. The grains woke up, buddy. Build a
silo.
Yeah,
so here, we're in the beginning of this. And I think the primary driver of all this is going to be, they'll be on and off like
can't eat gold.
Gold, I think it's precious metals because they're undermining, the whole financial system. So,
right.
So I think that's going to be the primary driver of most of this. It's probably end somewhere around 2029. And then I think that we're in a very difficult market environment for a long period of time. I'm going to show you another reason that I think that that's the case is this. Let's take a look at VIX.
What was that, VIX?
This is my VIX chart. I haven't changed this for a long time. People thought I was completely crazy drawing this line here. But that, is what happened. The VIX is pretty much ready, I think, to go. And should be running from starting to run. But there's another volatility chart here that shows you why I think this is important. Basically, this is projected volatility. It's what I'm expecting. And it's not meant to be exact timing. It's meant to be basically within 6 months or 7 months. So I think we made a VIX low here. And then I think we're looking at basically new all-time highs into 2025 and 2026 in VIX. Wow. And that's why I think that we're not done when we finish our crash in February this year. This is the big picture for gold, which I think is very important. We're in this cup and handle pattern, which I think is completely viable. And I think that this is going to break out. I think we're in the shakeout now, and I think it's going to go, higher. And once it starts, it's not going to stop. It's going to go parabolic. Another big picture situation here I want to show is 220 years of assets. So it looks to me like what we're working on here is putting in this little itty bitty head and shoulders up here, and that we could be seeing a complete retracement all the way back to 1987 or 84 kind of price levels. And I think gold would go then crazy. The dollar ultimately will be strong, and bonds ultimately will sell off.
Wow. What a great interview.
Let's
not let this let's not let this much time this much time pass between us talking. And I'm pretty sure that after people see this, they're going to want to follow you.
Okay.
why don't you show people the best way to get a
Okay.
hold of you? I know you have a private Twitter feed too. I wouldn't be
Yeah.
surprised. Do you know
You
Michael
can.
Venezia? You
No,
know
I don't.
Mike? Okay,
No.
because he's a trader here. Okay, there you are.
Yeah. So
He's a
you can follow me at MCMCT USA, and then I have MCMCT Markets, which is private. That you have to register for on our website, which is over here. You go to subscriptions and you could join that. So mcm-ct.com, and that's how you guys can find me.
All right. Really, Peter, great catching up with you at such an important inflection point in financial history.
Yeah, it's really interesting times. Things are not going smoothly, and I want to bring up one quote here while I have everybody. This one here. So this is something you guys should all screenshot, because that's what's happening to the markets right now. I mentioned Marxism quite a bit on MCMCT because everything we're going through, MCMCT USA, everything we're going through is a Marxist sort of related plan in implementing this new utopia. And if you read this, Lenin explains how he wanted to do that. I've been sharing this for 20 years since I was at JP Morgan.
Yeah, debauch the currency.
Yeah, and create a disconnect between credit and everything else, and that's what they're doing. And I think that we're dealing with a very, very negative situation because
but the dollar
of that.
comes back, so Lenin will be challenged. So we're going to go through this, but we're going to come out of it. Maybe.
Actually, you know what? No. Let me show you one more chart. Let's see. This is actually a very important chart.
So we're going to have a lost decade here, Peter. From here,
well, let's
the end of the empire. I know the end of the empire.
1 second, I'm gonna try to get this. I should have had this chart ready. Let me just see.
Great reset.
I don't. Here it is. Okay, there it is. Okay, this is a really important chart that I made. I have a better version of it than this one, but come on, go away, Superman. Okay. Anyway, I'll just show you what I think is happening here, and I'll do it this way. Okay. So basically, what I think is happening here is that we're getting a complete unwind. Sort of like this. I think the yen is going to come back up, retest. I think that we're looking at ultimately after this bounce in the euro, collapse in the euro, collapse in the yen, a huge rally in the dollar, and then the dollar gets restructured, and then this commodity super cycle is all happening at the same time into 2029. And if you look at all this, when this is all done, this means nobody owns anything, and that's kind of what the plan is.
I've heard that you won't own anything and you'll like it.
Yeah. So that's kind of my thinking, and I'll just leave you. I think this is where we are. I think the markets are going to fail on this coming bounce right now, and I think that bounce is a short, and I think that we're looking at a very severe down move from here. If we are lucky to get basically 44.25, 44.30 on this bounce, I think we're basically dead in the water after that.
Okay, fade Peter at your own peril. That's all I could say, and I appreciate you being here, Peter. A very elite and a lot of work and intense thought went into this with all your training, and appreciate your giving nature to share it with us here today, because I know it's the time it took. You're kind of like awesome. You're a watchman for people that right now might be oblivious to what you're talking about. So I
Yeah.
hope 100,000 people see this, and we could save some heartache for others. And
Yeah.
thank you very much, my trading warrior brother.
Yep. Thank you, Dale. You're awesome. I love what you're doing. It's a really great project.
We'll talk soon, bro.
Okay.
And good hunting, Peter. Thank you so much for giving us so much food for thought. I'm going to have to watch it again myself.
Okay. Awesome.
Thank you, buddy.
Catch you later.
So follow Peter at MCM_CT_USA on Twitter, and get ready. And
Yep.
thanks everyone for your attention.
And can I just go through? Actually, before we let you go, let me show you one other chart that I think we can touch on, because the gold situation is very important. We made a minor new low here.
Yeah, today.
It doesn't invalidate this at all. We have what's called a bullish dragon pattern.
Yeah.
And basically, I'm expecting that something like this is going to happen as soon as this shakeout is done. So, I'm going to have to move this D down a little bit for today's low. I'm guessing probably today gold comes back up and leaves a long tail again. It just shook everybody out. I really think that the antidote to what's going on in the world right now is gold and silver. I think Bitcoin is not the antidote. I think this rally for Bitcoin is a fade. And I want to be honest with you about what I think is going on with BlackRock and all these other guys trying to get into the Bitcoin space right now. I think that they want to trade the decline and take everybody's money. So the Bitcoin, the longer term charts that I have for Bitcoin are not positive. They're looking way down, way lower. I'm
9,
sorry to say.
9,000?
No, way lower than that.
Okay.
I think that this intervention by these people to get in these markets is deliberately designed to be able to
Isn't
receive,
it enough
to receive the capital that people have in there, and to basically get those people to have zero,
because they're going broke with other projects they're wrong on.
Yeah.
And they're not happy being the landlord of America who scooped up all the foreclosures and are now renting to people for twice of what they were paying on their mortgage in 08.
Yeah.
So I'm not a fan of BlackRock, but I
No,
am
me
your
neither.
fan. I am your fan, bro. Thank you, Peter.
Okay. Catch you later.
All right, buddy. I'll get the link to you a little later.
Okay, bye.
Bye-bye. See you, everyone.